All right, people. Good morning. Good morning. So we're making it through the week. We're going to get some jobs data today. And while it's not non-farm payroll, it is jobs numbers. And you want to pay particular attention to anything to do with the job numbers as it goes to the heart of the Fed's dual mandate, right? If you're new to trading, maybe you kind of overlook the role or the importance of the Fed and what they are tasked to do. But sometimes they pay more attention to the job numbers and they highlight it for the market, and then they make the market focus on it more. And then other times they don't, right? Job numbers are always going to be an issue. So you should always pay attention to any job numbers that come out, even the silly ones like JOLTS, anything to do with employment. It can be a great heads up. So we have those today. Some, it's not the biggest. UK's down 0.75%. Japan up half. Hong Kong basically flat on the morning. The Dow at a half. S&P more than half. NASDAQ 0.75%. And small caps again running away with it in the pre-market. We've seen this a lot lately where we get these small cap overnight runs. But once we actually get into the trading day, they just fall behind. And for me, it's because these small caps are what we call event driven stocks. They don't have, good, clean daily, weekly, monthly charts. They just sort of look like one of those triple leveraged products that have a downward sloping chart, and then they get an event that pops them, and then they fade back down into another event that pops them. And right now they're getting a lot of attention, so they're getting a lot of that push, but it doesn't sustain. And it's still not a factor rotation yet. It's not broadening out, but there are, as we've talked about before, some ETFs that you can use to monitor the whole small cap space. Kind of keep your eye on that as a group. So we're going to get initial jobless claims, and we can see the numbers. They're not very far apart. Labor costs look a little wide. And there's a significant change in productivity. All those numbers are going to come out at the same time. And we always have to worry about revisions. The firing of the BLM employee, and that's going to have waves, repercussions. Got Fed speaker today, and then credit at 3. We got the 30-year bond today. Make no mistake about it, this is a big one. We're not supposed to have favorites. We should approach all of the auctions with, a bit of trepidation, but that 30-year, that thing's got weight behind it. So watch the clock, right? Pay attention when we get close to 1 o'clock this afternoon. Just be ready for a little bit of violence. Not expecting it, right? But you don't expect to trip and fall until you trip and fall. So we got the Bank of England, Bailey out chipping teeth this morning. Not really expecting anything out of them at this point. There's a little bit of concern right now with this push to get Russia to the table to talk. We seen Trump yesterday kind of leaning against India about buying energy from Russia. Well, China's the biggest one. And we just had this, fight with them over tariffs. And if he's going to continue to use tariffs as a wedge to force countries to not buy energy from Russia, and he tries that with China after we just settled everything on the China front, it could reignite that again. So we had the dollar move back down to 98. It's a big structural level. And this move down in the dollar lines up with this move here in the ES to the upside. It's not necessarily a cause and effect, right? We didn't go up because the dollar went down. But the dollar going down sure did help with us trying to get back up. If this structural level holds and we bounce here and do more than just consolidate, this is what we want to see. This sort of behavior is what we don't want to see, especially if it's headed back to the upside. Keep your eye on the dollar. Say 98 and 3/4. That'd put us near the low of this box. But 98.5 would be better. It's a nice, easy round number. Let's keep it under 98.5 today. If we start to get above that, I think the markets today, at least, could start to show their feelings on that. Maybe get a little salty. This is the ZB. It's the 30-year. And this move up lines up with this move in the ES. But then we've kind of just topped out with holding here. This uses fractions. I know it's a little weird. Most of the market used to use fractions back in the day. And it's like a 1/32. Right? So if it's 115/16, then it's like 115.5, right? Because if you have 16/32, I know it's too early in the morning for fractions, right? But that's half. This is basically half. It's 15.5. That's back when we were running teeners and eighths. Those days are done, thankfully. At some point, they'll swap over even old ones like bonds and everything will be decimal, but not yet, not this morning. So let's keep this structure. We don't want to see bonds making big moves today. Certainly not the 30. With that auction at 1 o'clock, it's just /ZB if you want to keep your eye on that. I mean, there's other metrics you can use, but this one, most people should have it. Yeah, that's why they say trading was so prohibitive back in the day when it was more complicated and you had to actually use math, figure anything out. Now it's a lot simpler. Doesn't feel much simpler though, huh? So start with the right one. We got out of the box. We talked about this. When we set this high here on this pullback, hey, don't lay on the keyboard, big butt. My cat wants to participate in the morning briefing. When we set that low and we ran up, the discussion was, is this going to be a lower high and we fall away? Or was it just a pause on this run up and we keep running? In which case we wouldn't see this little bit of a pullback as setting a lower high. And that's what we ended up getting. So at this point, we do have the low and we have the previous high. That needs to be resolved. Some analysts will argue over this little area right here and define whether that's a lower high or not, and even a higher low. I'm not going to do that for any number of reasons, but the simplest one is if I turned this chart into a line chart, that wouldn't show as a pullback with enough to measure. So I'll just stick with this low down here and that high up there and our current drive. Now we can still see price pull back, say today for an example, and give us a good, clean, solid pullback like this one, which would give us a new higher low. And then, we could run up and we could break that high, which would have been a lower high. And we could continue to flesh out this complex topping pattern. So just because we're running up here doesn't mean that we're going to go back to this high or that we're even going to make new highs. We still need to know how this candle resolves and whether or not we do end up with a lower high, which is my expectation, to be fair. I don't expect equal highs or new highs yet. I think we're going to end up with a lower high here. But once we do get that lower high, the question is going to be, where's the low going to get put in? And I still like those 50s. So 63.50, 62.50, one of those. And be like down here where it was before. And sure, we could do a nice solid round number, but I don't think it would be 64 unless we actually run up a little bit higher. Say we come up a little short of this and then we could fall into 64. And that could be our high or low, but I don't think 64 is on the table. We don't have to have a pullback, to be fair, right? Of size. We can get a pullback like this almost guaranteed, but I'm talking about something with a little more meat on it. We don't have to get that, but it would be rare not to get it. It's more likely that we do get that deeper pullback than not. So we just have to kind of focus on, well, where would that pullback stop? And is it really just going to be a pullback? So should we, buy the dip or sell the rip? Suddenly everybody's talking about employment. And two of the Fed speakers yesterday were talking about how there's some mixed signals in the employment data, and that when it goes, it's very likely going to go very fast, right? It's not going to be this degradation of data to where we all kind of see it coming from a mile away and get to start positioning for it. It's going to be really swift and it's going to get really ugly really fast. And then the Fed will have to come in and cut and blah, blah, blah. Thing is, at this point, with the Fed already having stated they don't want to cut because of tariffs, they want to wait and see. If they do come out and cut now, it's going to scare the market because they're going to think, oh my gosh, what did you see in the data that told you to cut that I didn't see? Things must be really bad if you're cutting, and that's just going to freak everybody out. If they'd have cut earlier when they were still under a, just a cut for general purposes, that would have been different. We're past that. The takeaway is if you can find some cheap hedges, there's nothing wrong with picking some up, right? But I wouldn't position a large percentage of my holdings to the downside. Reduce exposure to Mag 7 and anything that's got an expanded z-score and it's above its mean and you're well in the green. Just reduce your position size, reduce risk, maybe find some cheap stuff to the downside. Spock Gamma likes to point out SMH as a short on the market, right? SMH options are cheaper than SPY and QQQ, and yet they will fall nearly the same way, right? S&P falls, the NASDAQ falls, then SMH is going to fall. And it just makes for a cheaper hedge or a cheaper short trade. So certainly something to look into. There wasn't much of a change to the options level between last night and today, which is why I didn't share a picture of the call wall and the put wall in that line graph. Well, that's not going to do any good. So you can see we made contact with that call wall last night, 64.26. It's very likely that we retest it again today in the regular trading hours. And the idea behind it is it's where we expect long calls to be monetized, which means we expect call selling at that location. And call selling is like taking a wet blanket and throwing it on a fire. It's just going to smother it. It doesn't mean it's going to put the fire out. So if we get all bulled up and go rip into the upside through 64.30, that call wall wouldn't stop the run. It would just dampen it down. I've seen it get to that level and stop just like hitting a wall. And then I've seen us cut right through it like it wasn't even there and expand well beyond it. One day with that call wall doesn't mean anything, right? How we continue to respond at that level and then what they do with it. Do they roll it up? Do they leave it in place? That becomes really important. And we're 1 week away from OPEX. I know it doesn't seem like it, but the first of this month was a Friday, and every third Friday is OPEX. So it only feels like we had 2 weeks before we got OPEX, but that third Friday counts. So next Friday we're going to be looking at options positioning, which would move that call wall anyway. We are back above the 10-day and the 3-day, so we're above all major moving averages. And when we look left, all we have is this last bit of price action on the daily, and then we're in blue skies. We have a little bit of a reciprocation issue this morning. Our distance from VWAP, now that we're coming back to VWAP, we have to be concerned about getting the same thing on the other side. So this is what we had. And if we cross VWAP, that's what we're likely to get. And that's not much of a surprise because when we look left, it's this pivot point from earlier in the morning. Still, it's a nice little trick that you can do, and it works, right? That reciprocation works for all sorts of things, including indicators like RSI. Reciprocation. So obviously we're inside day breakout. We got out of that really big bar and we're through the half back that we've been focused on. Now we have to keep it. It's like 63.54, I think. Yeah. And that's a long ways off, right? We're at 64.10 basically. So all we got to do is keep that, stay above 63.54 for the week, and we'll be good. Yeah. We've already reached the ADR half. Generally speaking, if we get to one ADR early enough in the day, we can go to the other ADR by the end of the day. The problem with that is we've already passed it. We didn't just get there and fall away. We got there and got above it. Now, the nice thing about this is we've got a really good trade setup. If we break back down below the ADR, target the other side. I mean, it's really that simple. But we got to get through it first, right? And I hate shorting from the hole. I just hate it. So I would be looking for some sort of pullback anyways to catch it off of the high side. Still, from an analysis standpoint, if you're looking for shorts to run it, you could short at will once we got back below that ADR half line. The targets would be half of the Globex range and then the low of the Globex range. Yesterday's high, yesterday's mid, the RTH low, and then yesterday's full low. Level by level, we would run it all the way back down again. If we don't get back down below the red line, the ADR half, then we can come up and resolve 64.32 cog line, which is the full ADR, and we can begin to expand even further to the upside. Simple enough to just take that measurement and project it up. Take all of that measurement for the next level. So 64.64 and then 64.92 cog line. We have no reason to expect that we're going to go that high unless we get some sort of news or catalyst that takes us that far. And more likely, once we open into the RTH, the SPX will get its levels for the day, and we would run to the upside until the SPX hit its ADR levels, and that's where we would stop. That would be the more likely scenario. Otherwise, now that we've got it, we could just sit here for the rest of the day. If those job numbers come in and they're not really bad, but they're not really good, just some squishy numbers, we could just sit here and do nothing for the rest of the day. That would line us up for tomorrow's trading day. And if we widen that out a little bit, just bring in yesterday's RTH price range. That covers the whole ADR, a little bit of an overshoot down here, and that would be our trading day. It always starts with getting out of the box, right? The box that we have at the moment is our own Globex. And then to the upside, free run, and to the downside yesterday's levels. So it's a little bit of a gift this morning. Today's floor pivot is higher than yesterday's. That's bullish. Price opened above it. That's also bullish. The channel for the floor pivot looks to be a little wider than yesterday, but really not by much. If you have to squint at it, then it doesn't really count. This was a really wide day compared to the previous day, right? And that's a really narrow day compared to that wide one. When they're this close together, I wouldn't split hairs and haggle on it. They're both just a small range. Still, it is wider than we would want it to be if we expect a breakout to stick. The wider the range, the less likely it is that breakouts hold and that we actually come back in again. But these ranges don't make price breakout, and they won't stop us from running if we do break out. So far, we have an MDP, that's a missed daily pivot. We didn't hit this pivot today, therefore we have an MDP. But it won't count until the end of the day. The day's not done, so technically we don't know if this is a missed daily pivot until the end of the day. Tomorrow, if we look back and we never hit this pivot today, then it would be an official missed daily pivot. That's a trade strategy that I personally don't trade, but I do use it in analysis. You can just, hit Google or YouTube and type in missed daily pivots. You'll find the guy that really put a lot of work into it and has some background and research, so you'll better understand why it's even worth looking at. We're above the weekly pivot. That puts us in a bullish bias. And of course, with the breakout and the expansion, we're continuing that bullish bias. We don't have any reason to look for a short. Even this pullback is more of just trying to get back to the end of the kill zone than it is anything else. I mean, it looks a little blow off topish, but it's not extreme at this point. All right, we're not getting anything out of the profile this morning since we left all of it behind. We could sum all this up with one single distribution, saying we left it behind, or if we want to get more nuanced with it, then we did have a double distribution down here, but we're still outside of all of it. We left the point of control behind at 63.32 cog line, and we overshot this point of control like it wasn't there. Yeah, absolutely. That's what we got to focus on. You like that level, huh? So last week's structure here is what we're fighting right now. And that extends all the way back for 2 weeks, this double layered point of control. We made it through. We want to see it act supportive now that we're on the top side of it. What I'm concerned with is that we're actually going to begin to stick there like we did back here in the later part of the week, and we just chopped around before we finally had a little push into the end of the week. We could now do the same thing between 6,400 and whatever our Globex high was, this 64.28-ish. It's a really tight 28 point, 30 point range, and we could just sit there and chop into it. Ten-day, 30-minute volume profile and TPO, we are there. And we're not expecting to see that line move at any time soon. right? Any of these lower levels, now that we're back here, if we start putting in more weight, we're just going to build this high volume node out even more. So we're losing candles on the left for each new candle that we get on the right. But if we're putting work in here, we're just going to be building it out again. None of these lower levels gave us enough to expect to see that point of control move anywhere. And if it is moved, it's likely to be very temporary. We could see it come down into this 70 level before coming back up again to where we are now. So we got to keep above that 63.50 area. It's a bigger line in the sand that we can see on all time frames. Really just want to keep our focus on that. We don't have an MDP today, or a VPOC, since we opened there and we cut through it. Now, a lot of analysts will say, well, that don't count because we did it at the open. A lot of other reasons. You do you. If you don't want to mark it, don't mark it. The textbooks will tell you to mark all of these lines. The value area low, the value area high, and the point of control, whether we hit those areas or not. I'm not going to mark it as a VPOC today. It's just a line of interest. If we drop back down, I want to know where that is. But other than that, it's not an untouched point of control, so that's not going to help us out. Not really much of a disagreement between today's TPO and today's volume profile either. Things are looking pretty good, all things considered. And we have expanded beyond the range of the week's expected move. All right, now this is a 1 standard deviation expectation of price movement. It's a really generic concept. It's been around, I don't know, 50 plus years. And it's based on the trading activity within the options from last week, right? And the lines were set after the close on Friday of last week. So we use that looking forward into this week and projecting what a normal move in the market would be for this week. It's a 70% standard deviation, 1 standard deviation, 70% range. You can twist the words around and say we should stay in this box 70% of the time, or that we should close in this box at the end of the week 70% of the time. I tend to focus on breaches of the week on Friday's close and then counting back over a 10-week period so that I don't have to count all of the weeks and, develop a longer term average. Just a short count back over the last 10 weeks. Because what I've noticed is if things really start to deteriorate out there and it's just starting to get bad, we will breach that expected move range and close outside of it on Friday multiple times. And we're not supposed to do it more than 3 in a 10-week period, right? Because that's your 70%. So if you count back and you have 4 weeks that closed outside or 5 weeks that closed outside, then we're breaking our average. And it's a heads up that, hey, the market's not pricing in the volatility that we're actually getting, or the dealers aren't, pricing in the volatility that we're seeing. So far, the week isn't over, so getting outside the box is just a breach. We haven't closed outside of that because today's not done and the week isn't over. So far, it's just a good start. We had a nice example of the same thing back here where we were range bound for over a week. And markets, when they go sideways, they build up energy. So this was like sitting on the charger, just building up energy, and then away it went, right? Beautiful move. And then the same thing happened again here. Went sideways, built up a bunch of energy, big move. Now, those two examples were narrow ranges. We had like an NR7 and an NR6 or NR10. Either way, they were narrow range zones. What we've been focused on is these two really big bars and having an IX10 outside of those big bars. And who cares? Because they're really big bars. They don't provide the same sort of push or fuel that those narrow ranges provide. So sure, we were sideways, we were IX10, and we've broke that range, and now we're on the run. But I wouldn't expect the same sort of follow through as we had on those other two examples, simply because it was a much wider range. We're still above the 10-day, more than 0.5%, so we're starting to escape from that gravity zone. But we're not extreme because that is beyond the 1% level. You can see when I put my mouse around 1% that we've stayed within that 1% range a lot this year, even just the last few months, right? We've just been sitting here, and it's a good spot to be. Holding above the 10, it's healthy, and it's not extreme. So we're not overbought or overextended, and the broader market does really well when we're sitting in this kind of nice, clean, healthy spot. And it's where we are right now. So sure, we don't get much out of the indices this way, but we see a healthier, better backdrop in the market when we're sitting this way. So we're in a good spot. And it does kind of answer the question on this move over the last 2 days. Did we move too far, too fast? And does it owe us any sort of a pullback? And the answer is nope. Now looking at the 10-week, we're back into that 3%, and it's a little much, but when we look back, we can see that we've been well above the 3 multiple times this year, and it's been fine. We kind of heat up a little bit, and then it calms back down. And as long as we're just holding above that 10 and we're not pushing into 5.5% and 6%, then we're not getting into the extremes, and everything is fine. So this is good, clean, healthy. We're not overbought, we're not overextended, and we're not getting ahead of ourselves. It doesn't owe us any sort of pullback or mean reversion. From a money rotation standpoint, things are looking a lot better. When we came onto this grid the other day, most of these were down more than 2%, and some were closer to 5% over a 5-day period. Utilities was the only one that was green. So utilities been sitting on the sidelines. It's now basically flat over a 5-day period. But a lot of these others that were heavy negative are either flat, like tech, or actually up, 1% or more, with staples dominant, more than 2.25. That's a little bit of a flight to safety to see staples up like that. And it's not a surprise, right? The Mag 7 was crowded. They were getting beat down a little bit. And we saw people abandoning them till yesterday. So where are they going to go with their money, right? They went into safety, staples, and I mean, yesterday retail was going crazy, right? It didn't almost matter what retail it was. It was like all across the board. TJ Maxx, Dollar General, Target, Walmart, Costco. It didn't matter, right? Even Dick's Sporting Goods was getting lit. But those are, low movement, low beta stocks. Like if you're using the beta measure. And they are a signal of a flight to safety. I've exceeded Thinkorswim's allocation. That'll do it. Yeah, IPO. That's one of the ETFs that we use to monitor the small cap space. It's an IPO is the name of the ETF, and it had a breakout or a breakdown today. It just continues that theme of keeping your eye on the small caps. So starting with what's down, we got the Mag 7 down volume is down, which I understand that can be a little confusing. But you don't want elevated levels of negative volume, right? And that's saying that the levels of negative volume has decreased significantly. It's down 2%, which is good. When I flip it around, we should see that up volume is up. And that would be positive too. Then we've got healthcare, China, and they're not up enough or down enough to even hit our radar. So other than the VIX being down 3.5% and down 20.5% over a 5-day period, we got nothing to the downside. Now looking at what's up this morning, industrials, building materials, banks, finance, robots, energy, Mag 7, quantum, precious metals, miners, Bitcoin, China, more China, Bitcoin, tech, solar, chips, which is odd with the administration piling more tariffs onto chips, but whatever. Mag 7 up volume as we expected. We'll see if that support holds. All right. Chips are up almost 2%, but it's been in this wide range and it's still in this wide range. And it's also a really ugly head and shoulders. I know you might not see it here, but there's the left shoulder, there's the head, and we're working on the right shoulder right now. I said it was ugly. Either way, these last two red bars, they set the range, and that's the range that we've got to get out of. We're above the moving averages, so that's good, but we got a significant divergence against the MACD down here. Of course, it's been there for a while, right? This thing's been falling out of bed, and we broke new highs up here, or at least new highs on the year. Right? Yeah. So it's not like that divergence is new. All we got on XRT is a little bit of a algo print, but look at retail yesterday. I mean, it was going crazy. Nice moves, by the way. But this morning, it's just some algo prints way up there. And even on this one, we're still in the middle of this range. Got a nice TRB setup. It could give us back, you know, to that 88, 83 half. Pot stocks, silver, precious metals, crude, emerging markets. That's basically China, Mag 7. Just some algo prints up here. Owes us back to the top of the range, and we're almost there. Bitcoin. Some dark pool prints. That's ugly. So Bitcoin's on this lower structure, and at the bare minimum, we could work on closing that gap around 22. Of course, I'm just using a Bitcoin ETF. This isn't the big dog, but any of those, a lot of them, I can bring up 8 different Bitcoin ETFs. They're all going to look like this. Uranium, same thing. We're just, all these charts, they just got to get back to that previous high. The question is, if 85% of the market has this kind of V shape or U shape, and 85% of the market is about to hit its head on resistance, what do you think's going to happen when 85% of the market actually hits its head there? Very likely we stall out, right? Or worse, fall back in 85% of the market. Even if it's just for a first touch rejection, you know, to get our footing and then break through it anyways. We got 39% of the NASDAQ this morning up at least 0.5%. There's the chips. So we got a lot of chips up this morning, at least 0.5%. And then, of course, we can probably spot the Mag 7 in here. Google, Apple, NVIDIA. But not all of them, right? Just a handful of them. And 42% of the S&P is up 0.5%. I mean, it's not bad, right? But it's not all wild bullish as much as you would expect, looking at all of those sectors that we saw that were up this morning 0.5%. So it really does seem like we're concentrated back into the same group again, minus a lot of those Mag 7 guys. We got some in here, but not as many as I would have expected. 2 between Apple and NVIDIA. 4 if we count Microsoft and Google. But what, that's it? 4 out of 7 or 4 out of 10? Not impressed. I don't want a rally day based on Home Depot, Lowe's, and, you know, Harley Davidson. So whether or not it's going to stick would be whether or not we continue to see some assistance out of the Mag 7 communications, chips, tech. It is laid up really nice for us today, guys. If we break VWAP, target the ADR line. And if we break under that, short it all the way back down, right? That's what we're resting on right now is a VWAP level. So break VWAP, get to the ADR half, break the ADR half, focus on Globex half. Then yesterday's high, then Globex low. And it'll just be running the levels all the way back down. But expect sideways, that we don't actually get to stay above this yellow line up here, which is the full ADR. I think that could be our upper edge today. And that we don't get below this lower ADR without headlines at least. And that this could just be what we have for the day. Just right there. So I got for you guys, be careful, be safe, keep your eye on the clock. We got 7 minutes till we get those job numbers. And we got the 30-year today at 1 o'clock. That thing is a big one, right? So you want to keep your eye on that. I'll see y'all tomorrow.